All right, we're going to go over peaks and troughs. Pivot points create support and resistance. So, a little rundown. We're going to go over pivot points. Then we're going to see how they turn into support resistance. And why ranges happen. Why do we have ranges? And then some resources and notable people. And DeMark Williams and Gahn kind of had a similar idea of how to identify pivot points. So the fact is in a trend or a range, you have peaks and troughs. So pivot points are identified as a change of direction, right? So these peaks and troughs in this photo are a change of direction. That's all that is. People call it a reversal, a top, a bottom. You can define it the way you want. But if you look at a mountain, just think of peaks and troughs just like a mountain. You have your mountain peak and then it kind of declines, and that would be the trough at the bottom. There is another peak, another trough peak, and then it goes down. For a continuation, right? You can see trading all over the world. So down here, when you look at your chart and you start drawing these, just, try to identify the peaks and troughs. This is going to help you, and it's going to get more confusing in the next slide. So remember this picture. So the peaks and troughs in the last slide, this is the exact same chart. So pivot points converted to support and resistance. So a trading range with support and resistance has peaks and troughs, and ranges 100% of the time will pass the initial peak, or it will pass its initial trough 100% of the time. And this is a fact because the price never just bounces between a range forever. One day it has to leave. It has to leave that range, or it has to leave that support or resistance, just like here. It always happens, and you have to be prepared. In trends, it's the same, but at a different angle. You can see two different perspectives in one drawing. It's not so simple, is it? So right now it's not simple, but depending on your technique and your trading plan, which I'm going to go over a lot of different styles, you can trade both of these. You have two options. That's how I see it. If you're this person, do not tell this person they are wrong. They are just trading differently than you. Both ways can work if you properly manage risk. So yes, you can see the chart from two different perspectives. But the key takeaway is that these peaks and troughs, right, can create support and resistance. That's all that means, is that you can use both methods. You can have confluence where you have your trend line and a resistance line, and you're watching for that. You're watching for the breach of that. Because if it breaches this resistance line, you can say, hey, it could hit the top of this trend line next. However you use it. I'm not trying to give you a strategy. I'm just going over peaks and troughs. You can look at it different ways. So psychology, and this is mainly for ranges. We can ask why support and resistance happens, or ranges, right? Why does it happen? So I wrote this down, but I'm just going to say it in my own words. A lot of the times when I was buying a stock, it would immediately go down right after I bought it. And I start panicking. I have that fear, right? And then I look on TV and there's bad news, the Fed released, that they're going to increase interest rates, or something on the news. And I'd feel the pressure, and all I would want is like, please go back up. I'm gonna get out of this trade. I just want to break even. Let me get out, please. We all have that hope, right? So that would create a resistance, right? We all want that second chance. And inversely, you'll sell at the very bottom. As soon as you sell, for some reason, the price goes up, or as soon as you're liquidated, or as soon as your stop loss is hit, the price just reverses. And in your mind, you're like, oh my God, I can't believe all I had to do is move my stop loss a little bit lower, or, not use as much leverage, or, all I had to do is be patient. I was right all along. Well, that second chance does come sometimes in ranges. So this is very common. This is a very common thing when you first start investing or getting into trading. I've experienced it. And this evidence is supported by data. So I'm not just telling a story. This is supported by data, which is the chart itself. And it's also supported on forums. A lot of people experience this. And so ranges could be created that way. I'm not saying they are, but they could be created with those feelings, because what the chart is just people's emotions. It's just depicting what people are buying and selling. The chart is a fact, the history of what happened. So oftentimes the solution, or the next phase, the phase I went into, or the day trader might go into, is, dollar cost average, or, sell when the price is going up. So start taking shorts or sell the stock when the price is going up, and buy when the price is going down. So as the price is going down, you're buying and buying and buying. And what ends up happening is you start catching knives and you start holding the bag. And that happened to a lot of people in the last crypto bear market. Is as price was falling, people are like, at 40K, it's gonna hold at Bitcoin's gonna hold at 40K. And they bought a lot of Bitcoin at 40K, and then it just kept going. Down to 30K, people are like, it's not gonna break 28K, and then it broke 28K. And then people were like, it's not gonna break 20K, and it kept breaking. And a lot of times you get caught holding the bag, you get liquidated, so this creates traders who trade against the trend. It's a phase that I went through. It's a phase that most people go through, is that the price will be skyrocketing and you're just like, oh yeah, everyone's wrong, because this is who you were and you're trying to do opposite of what you were doing, right? So there is a way to get out of both mindsets. And I'm telling you that both mindsets aren't wrong and they're not right, right? You just have to find a strategy that will protect you against buying the top, selling the bottom, and then you catching knives or holding the bag, so we'll go over that in later videos, but that's the phase that I went through. If you're a trader and you can relate to that, like, don't worry, there's a way out of that, and I will show you. So we're going to go over Tom DeMark and Larry Williams method and pivot points defined. So both DeMark and Williams determine that a true peak has at least 2 bars in a row that are higher than the previous bars. So I annotated that, so this bar, right, created another bar that was higher, right? And there's a lot of volume in this, right? And then they didn't mark this pivot point until they saw the next bar going down significantly, right? So there's like, all you have to do is read this and look at your hand. That's what they meant. They meant that a peak is created like this, like a human hand. A trough is created like the human hand as well. So that's what I just marked on the chart. It's kind of hard to digest, but that's how they defined it. And there are certain circumstances where, like, you would think this is a pivot point, right? Well, they missed out on this pivot point because it didn't have the 2 bars following it later. So they weren't able to capture that long, which was a pretty significant long, because of this rule they had, right? You need 2 bars before, 2 bars after that rhyme. So they would see this and be like, that's a pivot point. And this, it's hard to explain. Anyways, look up Tom DeMark and Larry Williams' method. You get to see how they did it. And so Gone had a 2-bar swing, and he used the daily chart for this, and we're going to go over it on the daily chart. So Gone had a 2-bar method, which basically meant that following a pivot point or a peak or a trough, you must have 2 bars that are negative. At least 2 bars. It could be 3, 4, 5 like this one, right? But this would be a pivot point because it has at least 2 negative bars following. Or 2 red bars. So this would be a pivot point because after this bar, there was 2 negative bars that were initiated. So this bar right here was lower than the previous bar after the peak. That would be a pivot point. I'm going to explain it a little bit differently, and we're going to use the 4-hour. And so this chart right here is the same. Let me pull it up. As this chart. So I just want you guys to know that it's the same. It's the Ethereum chart on the 4-hour. So if we look at it, you're going to identify that this is a peak and this is a trough. This is a peak, this is a trough, this is a peak, this is a trough, so on and so forth. So how do you draw that? So as you take a peak, a easily recognizable peak, right? You would want to mark this as a pivot point, right? And mark this as a pivot point, mark this as a pivot point, mark that as a pivot point, and so on and so forth. And we're just going to draw this in. So looking in hindsight, it's easy to identify peaks and troughs. And we're gonna end it soon, don't worry. Now, does this establish a trend? Like this was an uptrend and then it turned into a downtrend and then an uptrend. It doesn't really define much. And you'll stretch out the chart and you'll be like, that's kind of unreadable. Is this an uptrend or a downtrend? If you cannot read it, you need to zoom out. You know, I would suggest going to the weekly and starting out. That's why you have to start out from the higher time frames to the lower time frames. So we can see that this is a pivot point, right? Because following this bottom, we had consecutive candlesticks and a peak. And you can identify this as a trough. You can clearly identify, is this a peak on the weekly? Or is this a peak? How do you decide? Well, if you look at the weekly, time frame, I like to have multiple candles, that are in a 90-degree direction, right? 90 degrees. And I'm not looking for anything like a 17 degree. I'm looking for 90-degree direction. And that's kind of hard to do. And the reason why is because when I draw a trend, this is obviously an uptrend, right? I'm looking for that same pattern, right? And I'm looking for that same easy, smooth pattern. So I don't really necessarily look for things. I don't trade things that are choppy. I trade things that are smooth. So I would want this to continue as it did in the past. Now, where do you stop? Where do you decide, you know, where's this going to end up? Is it possible that it will end up in this area? So we have to look at the chart and identify other peaks. So this would be considered a peak and a trough to me. A peak and a trough, because if you go down to the daily, if you zoom in, you have this nice little price range right here, right? You have this nice little price range. So if you grabbed a box and you're like, okay, this was a trough. This little area right here was a trough. And you drag it out. Let's see if this played a significant role later. It poured right through right here, but it became, you know, it became a resistance. Let's see if this played a significant role later. It flipped to a support. So what I like to do is grab these little areas. Like this is a trough, right? And see what it does in the future. And for instance, this is a peak. Let's see what this peak does. And for now, we'll get more technical later, but just grab an area. Just grab an area like that. You know, was this significant in the future? So that peak may have played a role later on in the future. So what you need to do is you need to figure out what made this significant. What made this area significant? And down here, you know, right here, is this significant? So let's just grab this whole range. Let's just grab it. Let's see if it played a role. Because that's a trough. Let's see if it played a little role. So this range played in, the price played in this range before. The reason why I am pulling this out is because we're currently experiencing, and I'm sorry this is so slow, hold on. Does this play a significant role? Or did it in the future as a possible, you know, tap? It looks like it did, you know, and that's a wide range to look at, but there's ways you can refine it. There's ways you can refine this. And I'm just making a basic point, is that are these levels, are these pivot points in the future, do they end up helping us? And we're going to delete all this. Right? So we can grab a box and we'll grab the wick and we'll hit the body of the bottom candle. You know, did this play a significant role later? You know, will it play a significant role again? Same thing right here. Let's grab the body of the candle and the wick. this play a significant role later? Oh, let's lower that. You know, it's quite possible that this played a significant role, right? So that's all you need to know, is that that's how people generally look at support and resistance. Now, does it break out of this? Yes, it does. But there's a tendency to go back to these levels. I'm not saying they always do, but let's pull this all the way back here. You know, so this was a top, you know, it wicked in here, it came down, that was a support. You know, so do these roles play a significant role later? They could. And that's I'm not going to get too much in how to use this in forecasting. I just want you to be able to identify pivot points in the market. And later we will identify how to use these, how to mark these levels, and how to be able to trade off of them and give you a higher probability. So I hope this was not too confusing. So in summary, pivot points act as support and resistance. How do we identify them? That's something you're going to have to look into. And using higher time pivot points will help lower time frame trades. So the higher time frame that these pivot points are at and how we mark them will determine, you know, on our 15-minute chart whether to take a short or a long. The last thing I want to show you is Dr. Bill Williams. If you type in YouTube fractals trading, you'll get the practical fractal. And the video is long, but Bill Williams goes over fractals and he goes over pivot points in trading and how he uses pivot points. And you can basically divide it up into, he shows examples, and you know, he has his own theories and his own perspectives, but I would definitely watch Dr. Bill Williams, the practical fractal. It helped me kind of understand how pivot points work. I use some of his methods sometimes to identify reversal points. And like I said, I'm only going over the data, and these data points are going to give you, hopefully develop certain conditions that have to be met that will trigger your trading. So you're going to have situations where you have 40% probability, right? And so you might take that trade, but be more, you know, cognitive about your risk. You might have 90% probability trade and have higher risk when you enter that trade, you know. So data is just one part of trading. Technical analysis is just one part of trading. So we understand trends, how they work, where they came from, pivot points. Go over, research Tom DeMark and Larry Williams. Research Gone. And also watch this video. And this is really boring stuff right now, but you're going to realize that a lot of people have rebranded what these people have done. They've rebranded it, and I'm helping you out. All right, that's all I got. You know, stick with these courses. You know, keep learning. Stay the course. Stay on the right path. You know, grind at this. This is not easy stuff. All right, take care.